Hey, welcome, folks. We're going to be talking about buffered ETFs here. This is ETF.com webinar. My name is Jeff Benjamin. I'm a wealth management editor here at ETF.com. We got a great panel here to go into the details of buffered ETFs, how they work for financial advisors and their clients, how they become so popular, why they make so much sense right now. There have been references to these things as boomer candy, I guess, because they appeal to people that are looking to maybe hedge some risk but stay in the market. We're going to get into all of that about how these things work. There's a lot of nuance here, folks, and we've got the experts here to talk about it. We got Matthew Collins, Vice President, Exchange Traded Funds at PGIM Investments. We got Pon Veliun, Chief Investment Officer at Veta Investments, and we've got Amy Wu Silverman, Managing Director, Head of Derivative Strategy at RBC. I want to welcome each of you. Thank you for being here. This is going to be a lot of fun and it's going to be educational. I know I'm already planning on learning a lot. But first, I want to go around and have each of you introduce yourselves, if you don't mind. Matt, you want to start, please?
Yeah, thanks, Jeff, and thanks everyone for joining. I'm excited for the webinar. Matt Collins, I head our ETF business here at PGIM Investments. If you don't know who PGIM is, we are the $1 trillion asset manager for Prudential Financial, the large insurance company. So we have a very deep expertise in providing a lot of various solutions across our insurance business and then the asset management side. So thrilled to be talking about buffer ETFs today, Jeff.
Okay. And Pon, how you doing today?
Doing great. Hey, Jeff. Yeah, quick introduction. So my name is Pon Veliun, founder and CEO of Veta Investment Partners. We're an asset manager. We work with institutions, advisors, and wealth platforms. We were an early adopter of buffer ETFs and really have helped kind of smooth the portfolio for our clients. And yeah, excited to talk about buffer ETFs and defined outcome ETFs.
Okay, great. And Amy, hello. How you doing?
Great. Thank you guys for having me. So as Jeff mentioned, I work for Royal Bank of Canada. I'm the head of derivative strategy. What does that mean? We help institutional clients like asset managers, pension funds, and hedge funds look at the risk in their portfolio. That can be anything from structured products to options to hedging, and it runs the whole gamut. And happy to be here as well.
Okay, thank you very much. All right. So Matt, let's start with what buffered ETFs are. How do they work? Why do they work? Give us a little bit of a background on these things.
Yeah, I'm happy to. Thanks, Jeff. I think there's a lot of terms flying around in the industry around these products. You called them buffer ETFs. That is sort of the phrase that we've tagged to the suite. But I think if you're talking to a broad audience, we refer to them as defined outcome. And I would say the most popular style of investing within defined outcome is around putting what we would refer to as a window frame around your S&P 500 experience, right? And we know that, if you're looking at just today's valuations, they're a little frothy. But even in times of volatility, what we found is people know they want equity exposure, but they get a little uncomfortable with where the market's at or where it's going. Thus, the popularity of defined outcome ETFs. So I guess the 101 on defined outcome ETFs is they give you S&P 500 exposure, but from a 1-year outcome, so from day 1 to day 365, they protect against a certain amount of losses. So if we advertise downside protection of 12%, if the market is down 12% or less, you don't have losses in these products over that full year. Mm-hmm. But of course, nothing is free, Jeff. And your upside as you buy protection on the downside becomes limited. And typically you have upside up to a certain, what we refer to as cap. And what that does is it tells investors, I know I live, again, within sort of this window frame of equity market exposure. And that to us, and if you look at assets too, is a game changer for how people think about equity exposure and using defined outcome ETFs.
Okay, excellent. Amy, maybe you can kind of give us some backdrop, some macroeconomic perspective on why these things are appealing now, because they have just blown up in popularity.
Sure. Look, I think given the macro backdrop now, the context makes a lot of sense because essentially the type of market view that you're taking is you're saying, look, I'm kind of willing at this point to give up a little upside in the market in exchange for protection on the downside. Now, why would I be comfortable doing that? I'll maybe rewind a little bit to just kind of 1 year ago. As I mentioned, I work in equity derivatives. And one thing we can see sort of as a leading indicator versus the rest of the market is when the market really starts to feel MOMO and FOMO, I call it. So when they really start to want to participate. I would say, when you look to last year, that started to happen with the AI frenzy. So the first time NVIDIA, for instance, reported earnings last May, you just saw the market start to really ride this theme. It drove the S&P up. And we saw that exuberance all the way through until I would say mid 2024. And we've really faced an inflection point, Jeff, where the clients that I speak to who manage a lot of assets and are looking at their portfolio for the first time, they're asking the question, how much more room do we have to run, not only in these AI names, which are very, very heavy weights in the S&P, just, the 6 or 7 by themselves, but the market as a whole. So if you actually just look at average Wall Street S&P 500 targets, so just their targets for the end of this year and the end of last year, there's really no one who's calling for anything more than maybe 10 to 15% upside from here. That's in the next 6 to 12 months. So when, again, we talk about that upside, it's very different now than it has been in the last 2 years. Now, on the downside, one thing that Pon said is, one of the main drivers outside of interest rates is equity volatility. So essentially, when we say equity volatility, we mean how much do we think stocks are going to move up or down, right? Just the magnitude in the next 2 weeks, 1 month, 6 months, 12 months. One thing that it's really important to know is that equity volatility in the recent history has been incredibly low. So low that some of us folks in derivative strategy are a little bit alarmed by it. It historically doesn't stay this low for this long. And also when we get valuation levels where we have seen, there are typically triggers that reset it. So August of this year, early August, when you saw that VIX, the equity VIX headline spike into the 50s and 60s, that was, I would say, a red flag for some investors. And since then, obviously we've normalized a little bit, but most of us who work in equity volatility expect that to be much, much more inflated in the next few months, because the big thing that's going to happen is we're finally going to hit an inflection point with the Fed. And Jerome Powell has all but said at this point that there will be a Fed cut in September. The question right now isn't will they or won't they, it's how much. And the issue is, one big thing investors are talking about is if there are too many cuts, or if we get larger cuts than expected, is that because we're alarmed by the slowing of growth on the horizon? That's something that can take the equity markets down. But vice versa, and this is sort of why I think the markets are in a rock and a hard place. If they don't cut enough, then what does that mean on the employment side of the situation? And can that in and of itself be one reason why we wouldn't necessarily see further upside to the market? So, I would say the building consensus right now is there are a lot more risks that are asymmetrically geared to the downside than things that could necessarily drive us up further in the market.
That's interesting because I can understand how you would want to steer clear of risk, and maybe these buffered strategies could be appealing in that regard. But it is an interesting take on Fed rate cuts looking like downside potential for the equity markets. And I guess unless you're going to see a bunch of rate cuts, right, to fight a recession or something.
Yeah, and you look, this is interesting because I think the market is so trained to be excited about rate cuts. But the reality is, if you get too many, it really means there's something quite wrong.
Okay.
So, for instance, if we get to September and for some reason we get a crazy emergency cut. This isn't priced into the curve right now, but let's say we get 75 basis points. I mean, that's
Hmm.
not going to be a market that rallies on that news. That
Yeah.
means there's
Right.
something deeply wrong with the market.
Yeah.
And so, one thing that we do on my team is we essentially look at history. We look at when historical rate cuts happen. We look at how the market trades.
Hmm.
And it is not always the case that it implies a market rally. Every case is very idiosyncratic. And I think the market we're in right now, where again, one of the crucial points I would say is it's incredibly heavily weighted to certain names, where
Yeah.
I think the sentiment has really slowed, changed. It's much more of a show me story right now on numbers than it had been during the initial FOMO craze.
Uh-huh.
It's going to take a lot more upside to drive that exuberance.
Yeah, interesting because as I said earlier, these buffered ETF strategies are appealing to folks in or near retirement largely, but obviously if you're seeing potential uncertainty out there or potential downside risk, there's maybe this expands the market for these strategies. And one question I got to tell you, I think I've been around for a while. I know what FOMO means, but what's MOMO?
So Momo just stands for momentum, and
Oh,
the kids these days, I'm trying to use their cool lingo, but FOMO is just the fear of missing out, and momentum is sort of this idea that when you see people getting into stocks, you really have to dive in as well. So a simple example I'll give is, if you guys recall what happened with GameStop or AMC
yeah.
during the height of the pandemic, that's your key example of when the markets really run away with themselves to the point where, it was irrational. It was a chase, going even further back in time, something like the tulip craze, for instance.
Uh-huh.
But it's just this idea that, we've had these pockets post-COVID of really irrational upside exuberance.
Hmm.
And that has really been sucked out of the market. We really have seen most of that dissipate. And I can tell you from, my day-to-day, which is talking to investors about risk and the downside, those are much more of the conversations I'm having now. The asset managers I speak to, they want to know how to protect their portfolios. They've had a great run.
Yeah.
They're much more interested in what do we do if we get a downside tail event.
Yeah.
Hey,
Okay,
Jeff.
Momo, kids today.
Yeah.
I think that's what my wife called her grandmother, Momo. But
Hey, Jeff.
yes, sir.
Yeah, I'll have to kind of like respectfully disagree. Like I think buffer ETFs apply to almost every investor, even if they're 20 or 30, like, to Amy's point. Like if you think there's gonna be any volatility or if you're concerned about the market,
Hmm.
we didn't talk about the 10 buffer, but even an investor that's 20 or 30, they should consider, maybe an allocation to the 10 buffer. You protect 10% of your downside and you get, uh 12, 13, even 15% upside. Going into, if you look back, think about COVID or even the global financial crisis, you know, another thing is buffer ETFs really give you time. It
Hmm.
kind of slows down your portfolio versus having 100% into stocks. I think any allocation in a buffer ETFs, even if you're younger, is something to consider.
Okay. I think we're going to get into a lot more of that in a few minutes, Pom. But first, I want to get Matt in here to talk about what you're seeing as far as the appetite goes. I mean, like I said, I'm just saying what I hear from other people. This will be, I think, the third time I've referred to them as boomer candy because of the market that seems to be gobbling these things up. But as Pon just said, maybe there's a broader market beyond people in or near retirement. Matt, what are you seeing as far as the appetite? Who's buying these things?
Yeah, the boomer candy phrase has stuck, but I think those of us with FINRA licenses and compliance, try not to make headlines with phrases like that. So I'm not going to tag it to myself here. But for us, and I think this goes to where Pon was going, if you have a goal that you are trying to achieve, I think there's a few truths out there. One, not everyone, well, the vast majority of people are not as equipped as Amy to look at all of the factors that go into producing volatility or where the market is going. And not everyone has access to someone like RBC to help digest a lot of what's going out there. And what that leads to, from our perception and conversations with clients is there are two truths. One, you need equity-like returns to achieve your goals, whether that's saving up for a house, whether you're in retirement and you're trying to preserve, or maybe you're, middle class oriented, you're 15 years out, but you don't have enough money to really go full-fledged risk. You look at that, everyone knows they need equity returns, but what's the most overused phrase in our industry? It's cash on the sidelines, right? There is a behavioral component, Jeff, I think to our entire industry with sensitivities to equity-like risk. And I think Amy outlined it perfectly. There's just so much going on, and the average investor isn't necessarily equipped to digest it. If you look at this buffer industry, and I think we prefer the phrase defined outcome. And we'll talk about it later on what that means and the timing, but I think it's easier to understand what we're talking about if you refer to it as defined outcome. If you just assume that all of us as investors know you need equity-like returns, the defined outcome market is there to put essentially guardrails around your experience, right? There's caps and buffers that exist on these defined outcome ETFs that can help your average investor understand what their forward path looks like. And there's a slide that we've produced here that looks at the assets going into buffer ETFs. It's been explosive. And we're at 40 billion plus in defined outcome ETFs as an industry. This is an industry on the ETF side that didn't exist just a few years ago. Right. However, if you look at the broader space, this is very common in annuities, in structured products for financial advisors. So it's a concept that's existed for a while out there in the industry. And I think ETFs are just an added liquidity and a better vehicle than a lot of structures that are out there. And that's why you're seeing so much growth.
Yeah, you mentioned you brought up annuities and structured products. That's really, these things do have a lot of similarities there. Matt, or any of you folks, can you compare and contrast buffered or defined outcome ETFs with annuities and structured products? I mean, why is, aside from the ease of use with an ETF, can't you get some of this or most of this stuff in other products?
Yeah, Prudential, which is a separate entity, just to be clear. But on the insurance side, annuities have offered these type of solutions where you're giving an investor equity access. Let's just, for the benefit of the discussion, let's call it S&P 500 access, but they're putting a buffer, right? So if the market is down 10% and the advertised buffer was 12%, you're good. You have no, losses in that portfolio. But on the annuity side and even the structured note side, it's a fixed term, which means your money goes in on a certain day and you have very high exit fees if you want to leave intra period. Otherwise, you wait for the outcome to end, at which point you can, reinvest in a new contract or whatever it might be, or go somewhere else. With ETFs, the defined outcome is on day 1 and day 365. That's pretty much the same as annuity. However, and I think as Pon was referencing, halfway through the year, if you're up 8% in your buffer or defined outcome ETF, you may say to yourself, that's good enough. With an ETF, you have the ability to exit on your terms with no stated exit fee. That is why you're seeing explosive growth in ETFs, because it's that added flexibility for you to define your sort of entry and exit on the ETF side.
Well, let's talk about that. I was going to get to that later, but you brought it up. So entry and exit later. These are termed products, okay? They start, and like you said, day one is usually the first day of the month, and 365 days later, these things, that's the end of them. I mean, do they liquidate? What do they? I don't know what the term
No,
you want to
I'll
use.
jump in here, Jeff. That's the
Yeah.
beauty of the ETF structure. Like the
Uh-huh.
ETF manager or sub-advisor, they automatically roll for
Okay, they roll. All right.
yeah, so that's the, you can essentially buy and hold. I wouldn't recommend it, but the beauty of these ETFs is at the end of 12 months, the ETF team sub-advisor will buy a new package of 12-month options, and you get an email, or the website will be updated with the new cap.
Okay, but what happens if you want to do what Matt just suggested, and halfway through the 12 months you say, I'm going to sell this? Do you lose something? Do you not get does the cap not apply, or how much of the cap applies? How much of the downside protection applies? How
Good
does that work?
question. Good question. And we manage portfolios for our clients. And we do a lot of active management strategies similar to that. And
Uh-huh.
usually if we think the market has rallied a lot and it's getting close to the cap,
Mm-hmm.
we'll generally sell like the June or January buffer, and
Uh-huh.
there'll be a realized gain most likely, and then we'll roll it to the September, October. So we'll roll it to a new buffer with a higher cap and a new buffer. That's generally what we would do. We would roll it to another buffer. But that's where the beauty of the ETF comes in. The owner can sell it and move to another ETF, or roll to another buffer defined outcome ETF.
And I guess, Jeff, I'll reference the tools that we give our investors to maybe illustrate the story a little bit. So let's give a hypothetical example that on day one of this outcome period, let's just say it's an October product. If we advertise on that first day 12% upside, if halfway through the year the market's already up 12%, your buffer ETF, your defined outcome ETF, will not be up that full amount, because there are 6 months left in the outcome period, right? If there is time left, there is value left, right? There's no free lunch with these, options contracts or buffer ETFs. So what we do is we update our website every 15 minutes with real market data to tell people the buffer ETF is up 8%, as an example, and the original cap was 12%. That enables them to make a decision to say, I've achieved my goal out of this, and I'd like to move to something else. But most importantly, Jeff, and I actually think this is more common based off the data, you can hold this for years. You can hold this through multiple outcome periods. That choice, without having a hard sort of liquidation date like you'd have in a structured note, I think having both options available to investors to leave early or to stay on for years is why you're seeing so much growth.
Okay, but I want to get specific on that one point you just made, Matt. If it's got a cap of 12% and you're halfway through the period, and the S&P, the underlying, is up 12%, and you want to sell, I don't know if you can give me a specific percentage, but what roughly percentage would you get at that point? Remember, the cap is 12% and you're up 12% right now, halfway through the term. What do you think the investor's return would be?
So this is where I think Amy would be a great resource to talk about volatility and how it plays into the value of what you see. But typically what we've seen is about a 0.60 beta on average to the S&P 500. Meaning, as time, if you're halfway through the outcome and the market's up basically at the cap, from a time perspective, you should be about halfway there. but I think maybe I'll flip it to Amy.
Well, let me before you flip to Amy,
Yeah.
I want to. So you're saying you'd get 6%, right?
In theory, but there are so many factors: time, volatility, interest rates.
I know, but it because it's all theory, but because we're throwing hypotheticals out there. But I'm doing this for the sake of so investors and financial advisors listening can understand that that's the price you're paying in these things. You really are. If you're going to get in, you know, and it's up 12% right now, and you've got 6 months left, you should probably hang on.
The give up, Jeff, is if you invested in a physical S&P 500 ETF, 6 months from now, you would be up the full amount, right? Because you're in a beta product. But same on the downside. If the S&P were down 10%, you'd be down 10%. So I do think, to theoretically illustrate the example, if you're halfway through, you should be halfway to the upside that we told you, or the cap that we told you at the beginning of the outcome. That's the easiest way to think about it. And then there's, of course,
no, I understand, and I want to get to Amy in a second here, but I think this point is important. What if the S&P is up 20% and the cap is 12%? It's the same scenario for you as an investor, right?
Yeah.
So 6.
So if you're up, if there is a significant rally, Jeff,
right,
and the probability, let's just say your upside, let's just stick with the same numbers, 12%, but the market's up 40. The probability that the ETF gets to 12% all of a sudden becomes very likely, because if the market's up 40, it's got to come way down for you not to achieve your stated upside. So you would be closer to your upside potential there.
That's all right. Amy, did you have do you want to jump in and add some perspective?
Sure. Yeah. So, I don't want to get too technical. But essentially what Matt is getting to is actually the crux of what I do, which is, I think when people think about stocks and then they think about an option on a stock, obviously, they sound similar. They can be on the similar underlier, but a whole host of other drivers drives one versus the other. And, we refer to them as the option Greeks, but essentially the one that Matt is speaking to the most is this idea of delta. So it's the sensitivity of the option to the underlying stock. And when you trade just a simple option, so essentially all these products that you guys are talking about are implicitly long or short vanilla options. I mean, that's fundamentally, at the end of the day, the building blocks, if you will, of these products. And these options have something called delta. There's other second order effects, which maybe I won't get into now, but the best layman's way I've always thought about it is, if you buy a call option on a stock that is at $100 and it has a year to go, and the option's at $100, we call that at the money, meaning the stock is already there. And so what is the probability that it expires at that same price? That's the initial delta. That's the sensitivity that we assign. And, when you think about that, what I do for a living is essentially try to assign a view to where we think that will land. And it's not easily done, but when we think about the factors, they come very much down to things like, well, what do we think the Fed's going to do? What are we worried about? Are we worried about geopolitical risks? Are we worried about US elections? What are all the things that could make a stock move a lot versus not move so much? And that same exact idea applies on a S&P basis. And I think the reason why it's difficult to give you a look, this is what happens 6 months from now, is the reality is you're making a lot of assumptions. You're making assumptions about that interest rate curve. You're making assumptions about how much that stock is going to move up and down. And then you're making a lot of assumptions about acceleration too. And so, the best thing I can say is, you want to just, to me, when I talk about how to protect a portfolio overall, it's, it's not necessarily about the path, it's about what you think the end point will be. So just on a very personal level, if you think about your portfolio, okay, and there's something you need a year from now or 2 years from now, what are you okay with at the end of it? Does that make sense?
Mhm.
So, like, look, at the end of 2 years, I want to be able to do X, Y, and Z. So I need X, Y, and Z to be true or not true. Do these endpoints of these structures help me do that? And that's what I do for institutional clients. So, they could be up a lot this year. A lot of clients are, and they want to get to December 31st and not be down too much because they've had a great year. What put option gets me there? I don't necessarily care what that path looks like between September, October, November, December. I just want to know on December 31st, I can go back to my own clients and say, hey, the worst hit was down 10% because I bought that put option. So, that's a long-winded way of saying, yes, I think those scenario analysis are important, and I do a lot of that, and that takes into account a lot of effects like delta, gamma, theta, vega. But at the end of the day, if you want to keep it simple, it's about what you want at expiration day.
Yeah. Yeah, I know that we're just speaking kind of hypothetically in some of these examples that we're laying out there, but I just wanted to make the point that there are some moving parts here, and as Matt and Pon pointed out, you could be midway up, the S&P's up 12%. You're like, well, I'm just going to lock that in. You're like, no, you can't. You're not going to quite get 12%. You're going to get, maybe a lot less than 12%. But that's the price of, that's what you're paying for.
Hey Jeff, I can kind of speak untheoretically because we're probably one of the largest managers of buffer ETFs. So like similar to what Amy said, we focus on the downside. So going back to your example, let's say the S&P is up 12%.
Okay.
Let's say the S&P starts at 100, so it's at 112. What we'll do is kind of like Amy said, we'll try to roll up the put or roll up the protection. So we'll sell like the January one and buy the September one, where the put level is at 112 versus 100. So we focus more on the downside, similar to what Amy's saying, because we'll have the September one will have like a 10 or 12% cap. So you still get your upside, but we effectively have rolled up the protection level. So that's what we focus on when we manage money for our clients. And yeah, like I think some of the trades we've done have been in the largest in the industry, and we've experienced, yeah, kind of like Matt was saying, like, yeah, if the S&P is up 12%, generally you have the buffer, the January buffer ETF will be up about 5, 6, or 7, 8%, depending on the variables that Amy talked about. But the beauty of how we do it is we roll up the put level and buy another buffer ETF. So your put protection is at 112 versus 100. And then the new buffer ETF, you still have upside, a new upside cap that is potentially higher. So hopefully that helps.
Okay. Matt, let's talk about Prudential, your buffered ETF lineup. How long have you guys been in this space, and what do you have out there right now?
Yeah, I want to emphasize that, at Prudential at large, this has been, I think a core part of our business. And, we view this as a goal-oriented solution. If you have a goal and a time frame, these defined outcome products, whether it's over on the annuity side or with these ETFs, can help you achieve those goals. And there absolutely, Jeff, is an emotional component to this, and I think Amy outlined it, perfectly. If you can wrap your mind around the guardrails, all of a sudden it all makes sense. And I would say we have a lot of experience, almost 30 years using flex options. The buffer ETFs, we're about a year in terms of on the ETF side here at PGIM.
And what do you have? Let's talk about some of the, I guess the products you have out there on the market right now.
Yeah, well, let me maybe talk a little bit about our product development and how we landed where we landed. If you look at historical returns, Jeff,
Mm-hmm.
what we're trying to do with the S&P 500 is protect people for the most likely events if you go back 50 years plus. So I'll come back to the slide on historical returns. We have two series of S&P 500 defined outcome ETFs in the market. The first is a 12% buffer, and they are offered monthly with 1-year outcomes, right? And as everyone I think has mentioned on the call, that outcome that we sort of advertise and put our prospectus and our website applies to the first day and the last day. And then everything in between, you really have to check in with us on our website to see sort of where you're at. I'll come back to why we picked 12% and the overall market environment.
And I just want to, let's make it clear. When you say a buffer, that's the downside protection, right?
100%.
Okay. All right.
Yes, that's right. Yes.
Okay.
Shouldn't say 100%. The 12%, and the easiest example is if the S&P 500 is down over that 365-day period, if the S&P 500 is down 11.5%, you will be down nothing in that defined outcome ETF if the buffer level is 12%. That's how they work. And then again, everything in between, you really have to stay on top of the data that we provide on the website.
Mm-hmm.
Now, the other series is also on the S&P 500. It's also a buffer defined outcome, but it's a 20% buffer. So if the S&P 500 is down 19%, you will not be down over that outcome period. And we chose those buffer levels for a few different reasons. One, if you look at the chart that we've created, what you want to do is protect against the most likely event that could occur in the market. Because anytime you buy more protection than needed, as Pawn and Amy mentioned earlier, you're giving something up. There is no free lunch when you're putting together these option packages. So if you look at historical returns, more often than not, 70% of the time plus, the equity market is positive. And that goes back to what we discussed a little bit earlier. We all know we need to be in the equity market. That's I think fairly obvious for most people.
Right.
But are you willing to take the equity risk that comes with it? And a lot of times the answer is no. So then you move to what happens when the market is negative. And we've looked at rolling returns when the market is negative. What is that average experience for the S&P 500? The average negative return tends to be a little bit under 12%. So what we are doing with our 12% buffer is making sort of a longer shelf life product that protects you against the most likely events that exist in the market. On the 20%, Jeff, I think is actually pretty tuned into the times we're in now. You heard this from Pawn and Amy. Equity market valuations are way up. They've had an excellent run in the equity market.
Mm-hmm.
And now is what we're hearing from clients is that I want to lock in gains. I feel really good about the experience that I have provided my investors, but I don't have much confidence that the market's just not going to continue to go up. So they want to stay active in the market, maintain equity exposure. But the 20 buffer, we offer that because if there's potential or perceived potential for the market to really correct, we feel like that 20% buffer sort of takes you down into that, or protects you potentially against the 20% buffer should a more severe correction exist. So we try to give people choice with their buffer level.
I just want to make clear here, when you talk about a 12% buffer or 20% buffer, and if at 20%, for example, let's say the market is down 21%, you're down 1% as an investor, correct?
Absolutely. And if it's down 30, you're down 10%.
Right. You mentioned the buffer, but you didn't mention any of the caps. What's the trade-off? What's the cap on performance?
Yeah, so the trade-off, let's just stick with the 20 buffer because that is outside of the normal market experience that you've seen back to 1957. When you're buying more protection, more downside protection, which is
Mhm.
the 20 buffer, you're giving up your upside. And again, let's just use loose numbers. I want this webinar to have a longer shelf life. Let's compare the 12 and the 20. A 12% buffer theoretically could have a 16% upside cap experience.
Okay.
A 20 buffer, so you're buying 8% more downside protection. In theory, your cap is probably going to be anywhere from 11 to 12%, right? So you're giving up about 4% upside to get 8% more downside.
Okay.
Not to say one is right versus wrong, but it gives you a sense of what that trade-off is to get more downside protection over a 1-year period.
Okay. Are buffered ETFs, I mean, you could look at these in a number of different ways, but you folks have definitely kind of pulled back the curtain a little bit and showed the inner workings of these strategies. And it kind of leads me to believe that, I mean, you might need a financial advisor to navigate these things. What are your thoughts? I mean, can individual investors just kind of, roll these into their portfolio and let them keep rolling over, or is this something that requires, you think, an advisor?
We think it's applicable to a variety of audiences. I don't want to exclude, a retail direct client. I don't think that's fair. And we build everything we do, whether it's our disclosures, the data that we provide on our website, is open to everyone. You don't need to be a financial advisor to look at sort of the cap and buffer experience. What I would caution, Jeff, is everything that we've mentioned really comes back to performance management discussions, right? So the idea of checking in on your buffer ETF halfway through its outcome period, would everyone be equipped to understand why your buffer ETF is up 6% and the market's up 12%? I'm not sure. I think a financial advisor is in a fantastic position to have that conversation. And the last thing I'll mention on that note is, when the outcome period is over, you can stay in the ETF for 10 years if you would like, but the cap changes at the end of the outcome period, right? So we refresh the options package that goes into your buffer ETF. So you may have had 12% upside when you bought it the previous year. When we refresh the options package, it might be 14% upside and it might be 10. A financial advisor, again, is in a great position to monitor that dynamic.
Yeah.
And I think help clients sort of talk through a lot of the various dynamics that exist with buffer ETFs.
Now, we talked a little bit about buying in and selling in the middle of these periods. These things are generally 12-month products, or at least the buffer and the cap are set to 12 months. What happens if you buy, let's say you got a 10% downside buffer, and the S&P 500 after 2 months of the duration of this buffer ETF, the S&P 500 is down 10%. If you buy in at that point, what happens to your downside? Is that a good thing to buy when these things are down after the initial date?
I mean, upon, I guess, just quickly, I'll say that we've been focusing a lot on the upside, and I think, Jeff, this is a very fair dynamic to talk about what happens in the downside, right? So you buy on January 1st and January 2nd, if it's a business day, and the market is immediately down 10%, and you're in a 12% buffer, as an example, your buffer ETF will be down. And it will not be down as much as the S&P 500 because there's 11 months left to recover. But you will be down absolutely in the early period.
No, but I'm talking about buying after the drop.
So what would happen is if your buffer ETF is down, let's say 2%, and the market's down 10, and you buy at that point, Jeff, you've lost. If we have advertised a 12% buffer on day one,
Uh-huh.
Essentially, your new buffer, if you buy after that happens, is probably 10%, right? So you have a smaller buffer level that exists if you buy
Right.
post correction. Does that
Well,
make
no, I'm trying to say let's say you buy on January, or no, on January 1, the buffer is issued. All right.
Yep.
By March, the S&P is down 10%. Okay. So if you bought in March, wouldn't you effectively be buying in at the bottom of the buffer protection? So you could go up 10%. You're basically, it seems like it would extend your downside protection by buying in after the underlying is down. Is that not correct?
Go ahead, Pon.
You're partially correct, Jeff. I think it's like it's generally better to buy when the stock market is down, and that's kind of what my team and I specialize in.
Mm-hmm.
To take a big step back, I mean, when we first started studying buffer ETFs in like 2019, I think the first one
Mm-hmm.
came out in 2018, there was probably 30 to 50 tickers, but now
Mm-hmm.
there's probably over 300 tickers. So
Yeah.
my team analyzes all of the tickers in the universe. So yeah, you're correct. When the market's down, you generally want to buy. We would generally buy the March buffer versus the January buffer because the March has just come out, like you said, Jeff, and has the extra 10% buffer
Yeah.
to where the market's already down 10%. So that's where we specialize in. So yeah, I
To
would
me, that to me is a kind of like I don't want to say no brainer because nothing's no brainer, but it would be a smart strategy if somebody's
yeah,
paying attention. Why not?
yeah.
Why not do that?
Yeah, it's a great risk reward, and that's what we do. Like, yeah, if like the market's down 10%, and let's say Matt's team issues the March buffer, like the
Hmm.
March buffer, you're gonna have an extra 10%, so the market has to go down another 10%, and the caps are usually higher, like Amy is saying, because the volatility's up.
Yeah.
So we love
I
those
mean,
trades.
you always want to buy low and sell high. You're supposed to
Right,
buy when, but this is an example of you buy low and you basically you just added another 10% to your downside protection
right.
and your cap increases. I
Yep.
mean, you still got to hold it to maturity, but I mean, that's almost like buy because nobody wants to buy when I'm not nobody, but a lot of times people like when you get to 10% down, you're starting to get into some of those momos or something that Amy's talking about. I don't know. That's panic time. People are, oh, let's load up on this thing. But if you look at these things, to me, I think it's a little bit more nuanced. Probably need a financial advisor for this, but if a financial advisor is paying attention, saying this would be a good time to get into that thing and take that extra protection and
Yeah,
take that extended upside.
I totally
But I
agree
don't know
with
if you guys are marketing in that way
that.
at PGIM or anywhere.
I think it's much harder. I mean, we work with a lot of financial advisors, and financial advisors work with us. Like we manage
Hmm.
portfolio for financial advisors. I think if you have a lot of time, you can definitely do it, but it takes them a lot of time to analyze all the tickers over 300
Yeah.
and probably 400 now. But
It
that can,
does.
yeah,
That's a financial advisor's job,
yeah.
not mine.
So
Um,
I would say, Jeff,
I tell my team and clients, I feel like a Warren Buffett term, I feel like a kid in a candy store. Yeah, when the market's down, like there's so many opportunities in the buffered space. Kind of
mhm,
exactly what you talked about, Jeff. So yep.
yeah. I, did you have something to say, Matt, on that?
I'd say that there's an emerging product out there that's referred to as a ladder, which is very
Yeah,
commonly.
I want to talk about that now
Okay.
or next. Okay. Um, the laddered strategies, but first I want to talk about fees. All right, we haven't talked about the fees. If you buy you can get the S&P 500 for basis points these days. Okay, and most of these things are just benchmarked or pegged to the S&P 500. So you're basically adding guardrails around the S&P 500. Okay, so what kind of fees are we talking about with these buffered strategies? And at what point is it worth it? Or I'm assuming if you're offering these things, it's always worth it. But let's talk about the fees a little bit. What are we talking about paying?
Yeah, so I think the industry for a lot of the defined outcome and buffer ETFs started at 70 basis points
Hmm.
plus, and that continues today. PGIM is drastically lower than the industry average at 50 basis points for all of our defined outcome buffer ETFs. Here's how to think about the expense ratio, Jeff, and I know it's obvious, but I think it's worth just being very explicit about it.
Okay.
The expense ratio comes out of your upside in a good market, right? So if we tell you the upside is 12%, your actual upside will be reduced by the expense ratio. And we are really big believers in lowering the cost of your buffer or defined outcome space because it comes directly out of what you expect. And I would say we've taken a lot of effort to make sure that we're significantly lower than the average out there in the market. But same on the downside. If the market is down, if we're advertising a 12% buffer, your buffer is actually net of the expense ratio, right? So your buffer is 11.5 or 12 minus the expense ratio. So costs absolutely play a very significant role in your expected upside and downside. But to your point, it is more expensive than outright, sort of the S&P 500 going at 5 basis points out there in the market. The difference, Jeff, if you think about this, is one, the structure is different. It does take a full options package. But to offer a defined outcome, you can't just offer one product.
Right.
You need to offer every month. And then you have to offer buffer levels. It's an extraordinarily large business effort to launch these products. So there are heightened costs relative to it.
I understand. All right, we're getting close to time here, but I've got two more topics I want to get to quickly. One is 100% downside protection. I don't know if PGIM has any of those on the drawing board or anything like that, but they're popping up all over the place. They're saying, the heck with that 20%, 12% downside. We're giving you 100% downside protection. And there's obviously another upside cap. What do you guys think about that? Is that just going to replace the whole, 10 and 12 and 20% downside protection? Why take 20% when you can get 100%?
Yeah, I can.
Go ahead, Pon.
Yeah, I think they're a good complement, but I don't think they're going to take over. As you know, nothing's for free, and if you're protecting 100% if you're protecting 100% your downside, your upside is pretty limited. And we've started investing in these 100 buffer ETFs. I think the latest upside cap was around 7% versus 10 or 11% for a 20 buffer. So that's kind of the differential you see now. They're more interest rate sensitive than the 10 and 20 buffer. So if the Fed really has to lower rates, the 100 buffer is going to be the cap's going to be most affected. But I think they're a good supplement to portfolios, but I don't think they're going to take over. They shouldn't take over.
They certainly sound like a marketing dream, though, don't they? I mean, hey, 100%, you can't lose your principal. That's, to me, Matt, do you have a take on that?
I'll repeat that there's no free lunch, but the emotional draw of what you just described is really high. It resonates with a lot of people, but your upside is significantly limited. So you wouldn't want to think of it as your equity. You'd want to think it almost as a bond replacement out there in the market, but they are very interest rate sensitive. So there's a lot of complexities, but the emotional draw is high.
Okay, I like that analogy to bond replacement. And the last thing I want to ask you guys about is the laddered strategies. There are, that I know of, 2 ETFs out there. One of them holds just buffered, and so you just have to, like you guys said, you buy one of these and it will roll into the next one as it matures. But these laddered strategies just hold, you can hold these things in perpetuity, and it's going to keep rolling for you the full year. So there's one out there that does that. There's one that just came out from Calamos. It's 100% downside protection, rolling in a laddered strategy. To me, that seems like the ultimate turnkey solution. Is there downside to a laddered strategy?
So the laddered segment of the market is actually the fastest growing, and it's because of everything we just described on the call. The benefits of buffer ETFs are, I think, undeniable. the operational challenges are there, whether it's a financial advisor or an individual. The ladder ETF, at least the one that we have and some of our peers, just equally buys every month. It's very similar to how you think about maturing a bond portfolio. You're just sort of buying each month, taking out the operational complexity of management and reducing the timing risk, which we talked a lot about today, Jeff.
Right.
I think is you'll continue to see interest go to the ladder, so you can get the good benefits of it and reduce your operational thought process and workflow.
Okay. Folks, that is the time we have today. I really appreciate the panelists, and I appreciate the audience for sticking around and listening and learning. I know I learned a lot. I know there's going to be a lot more that I'm going to be working on in this area. Check out ETF.com, specifically the Advisor Center. We've got a lot going on there, and we're always looking for new sources and new story ideas. So on that, I want to thank Matt Collins of PGIM Investments, Pon Veliun, Veta Investments, and Amy Wu Silverman, RBC. Thank you very much, folks.